Yeah.
So I think there's going to be more guidelines in terms of how liquidity providers should be interacting with their customers and what's okay and what's not okay, and where you kind of need to be careful what the listing criteria is. My hope is that we're going to see more clarity there, and we're already seeing this outside of the United States, hopefully in the United States at some point too. The activity behind, again, like you and I talked about this a bunch of times, right? Like the separation of matching versus custody.
Yep.
Right. I think a lot of people are thinking about how to do that correctly and how much of that is going to make it to regulation. So I do think regulation will shape how, what kind of players are coming in from a liquidity perspective. I mean, RuleMatch has a great advantage there, right? Like you've been on this kind of like, hey, we're going to be an institutional venue from the very beginning. We had this conversation when you guys were first launching you were first launching the exchange. So I think it's very important. I think it's going to continue becoming important until we have, finite kind of clarity level.
Hello and welcome to another episode of RULEMATCH Spot On, the only podcast focused exclusively on the institutional crypto and digital assets industry. I'm your host, Ian Simpson, and if you want to know what banks, hedge funds, asset managers, and others are doing in crypto and how they're doing it, this is the place for you. My guest today is Anton Katz, co-founder and CEO of Talos, one of the leading tech platforms for order management, trade execution, and treasury management in crypto and digital assets. Anton was previously in the trade technology space, and he got a bachelor's from MIT many, many years ago. Anton, welcome to RuleMatch Spot On.
Thank you very, very much for having me in. I'm glad to be here.
So, of course, crypto is famous for many things, and we're not actually going to be talking about a lot of those things today, but instead concentrating on some things that matter most to financial institutions. And with crypto being a lot like FX markets, and some people have made that comparison, that makes crypto a bit famous for its fragmentation of liquidity, fragmentation of market structure. I'd be interested just to know from your perspective at Talos, with many financial institutions as clients, how do you see that developing? Is it getting more fragmented, less fragmented? How is it going?
Yeah, so I agree with you in general. I do think that in the eyes of a reasonable number of clients, the belief that it's developing a little bit similar to the FX market, and the fragmentation is definitely there. I think it's probably going to get more fragmented before it settles into some sort of a medium. What we are seeing is we're as the regulation progresses in every region, as the top players progress, right? This is, the FX market, you can check the numbers. I'm a little bit rusty on that, but the FX market used to trade like 15 years ago, a little bit more, used to trade about $4 trillion a day. Today trades something like slightly less than $7 trillion a day. Generally speaking, that means that the market has not been developing, very aggressively. Crypto market, in the meantime, probably added, not at the same time frame, but even less so, added at least an order of magnitude, and striving for more. So as we're seeing this market develop, both from the kind of players that are getting in and the regulation across the board, we are seeing more venues that are coming in with liquidity and trying to advocate for a specific clientele. So what we're seeing is we're not seeing, in effects, it's a little bit more saturated in terms of, venues try to compete on merit, whether it's on the, strength of the platform, on the strength of the relationships that they have, on the operational components of the platform, right? In crypto, that is the case as well, and we definitely see some of the leaders, emerging there. But also there are implications like, I can deal with this regulation, but others can't. I can interact with these kind of cryptocurrencies, but others can't. I can provide derivatives, but these guys can't, right? So the service is actually still materially different, and as a result of that, you see a bifurcation, you see fragmentation of liquidity. My bet is, while the market continues developing, we are still going to see some players come in and the fragmentation expand, but then at some point it's going to settle. And when you see the markets pull back, that's the last thing I'll say about this, you do see consolidation, which is kind of important. And that's exactly what we've seen in foreign exchange as well. So I think, it's a little bit more cyclical in crypto, and things are progressing. But generally speaking, fragmentation is, from what we can tell, is rising.
Still very much a thing. Is that a little bit like, like relationship managers from wealth management companies kind of taking their clients and then setting up a specialized external asset management just for them? Like these platforms think, oh, I've got this certain set of clients and I can just serve them with a kind of specialized offering?
I don't know if it's that granular. I think what is happening is that people do see certain areas of the market, whether they say, hey, like we are going to be a regulated entity that provides an off-exchange settlement, for instance, right? Like something that's generally pretty desired by institutional customers. Some clients, as our clients, we kind of tailor to those customers as well, right? Some liquidity providers basically say, hey, like we're going to go after the retail sector and this is exactly what we're going to offer. We're going to do a really, really good job at these particular things. So I don't think that there's a lot of like, hey, we're going to bring our Rolodex of clients and implement that. That does happen in some cases. That's not the majority. The majority say, we have something specific we want to offer. We see a segment in the market we can cover. We're going to go after it. And some, see this as like, hey, we have this specific license that we believe is going to be strategic to the development of institutional clients. They go after that. So that's just a couple of examples.
I think I know what you're talking about there. When Talos, what you do obviously caters to people who want to enter the market, but then across this fragmented landscape need some entry point, right? And are these clients looking at this fragmentation as a bug or a feature? Obviously, it could be a feature if they can take advantage of everything through Talos, right?
Yeah, so you're exactly right. It really depends on the clients. If a smaller client is getting in, right, for them, we cover some of the services and they're able to very quickly, from a technology perspective, the integration is N of one, right? You have one kind of integration that you do with Talos. Talos is a one-stop shop for those kind of institutions. You do one integration, and as a result, you get integrations with all those different providers. And then it's only up to you to figure out who you actually want to trade with, which is, by the way, our most common question from the clients is, who should I actually trade with? And clients see, today the fragmentation is definitely a feature because they can reach any type of instruments, any type of instruments is probably the right word, that they need for their customers. Ultimately, if you see tons of fragmentation and you see that, you really need to connect to 20 to 30 to 40 just to actually complete your execution correctly, that's not going to be very positive. But that's exactly, it's a free market, right? The market will react, and that's where we're going to see consolidation. People do tend to gravitate. So today, those providers are not offering the same level of services. There's almost groups of providers. Tomorrow, I think consolidation is going to make it a little bit more nuanced.
So you wouldn't say that people are really taking advantage of the fragmentation to the level that they could. I mean, at least smaller players, right? Bigger players obviously maybe have their own systems, or they are using you to play some of these games across different venues.
Yeah, what's happening right now is, the interesting thing that we see with the emergence of prime brokers, people are starting to be in a position to take leverage of the fragmentation a little bit more widely because, again, now they don't have to, we cover the technology and the execution. Prime brokers cover the onboarding and the credit relationships, right? At that point, you can really go and reach the wider liquidity. That happens quite often today. But again, it depends what kind of player you are. For the smaller players that don't want to work with Prime, but they want to work with technology provider, they're generally going to be, if we have a person that's coming in and it's a 5-person shop, it's a 10-person shop, right? A lot of times we will see under 10 connectors out of the 70 that we support today, right? And then usually what we see is as people develop and shops expand, then there's additional connectivity, additional connections. We also have quite a lot of data about where you should go, where you should not go necessarily for your specific means. Not saying that, hey, don't work with that player. Generally, we stand behind the liquidity providers that we connect to and we have integration to. But there are specific players that are going to be better for you, and we know how to make the choice or help our clients actually make the choice in terms of where to connect to and where to send your execution to.
We'll come back to the prime brokers and the venues and the choice of venues in just a minute. I'll be interested to hear about your insights on that. But another topic on fragmentation or liquidity, I mean, a huge part of the market is, of course, Bitcoin and Ether and then stablecoins.
Yeah.
And that's liquidity everywhere. Tether is the biggest player there, but then more and more stablecoins coming up, some for, it seems like, specific use cases or in specific areas, or then because of regulatory topics. How do you see the fragmentation of stablecoins and stablecoin liquidity developing?
Yeah, it's honestly almost like not too dissimilar from what's happening on the liquidity provider side, right? So you're absolutely right. The world right now is dominated by basically generally two, right? Like Tether is the gorilla in the room, probably about 125 to 130 billion dollars today. USDC is the second one that's trailing it, but significantly behind, but nevertheless trailing it, and is the sweetheart of a lot of the U.S. institutions, right? Beyond that, there's quite a few others that are coming up, but the parameters are now changing, right? People are starting to think about stablecoins not as a proper just US dollar equivalent, but actually something that you potentially might make yield on, something that you can facilitate your interaction a little bit faster with. Arguably, stablecoins are really the second big use case for digital assets. Like if you really look at the usages, like it's been incredible to see what stablecoins are used around the world. Like, you and I are living in the institutional world. Well, we care about settlement primarily, right? Like that's kind of like, we have a subset of our clients that cares about settlement deeply. And that's now done reasonably well through stablecoins. Not yet super widespread, but we are seeing certain classes of clients that do that. And what are the benefits? Well, 24/7 and basically immediate settlement, right? So you don't have to worry about Swift. You don't have to worry about quite a lot. As long as you're in the stablecoins, you can settle with your counterparty. But on the other hand, from our sell-side customers and some of the retail-facing customers that we have, we're seeing completely different usages. They're using stablecoins to enable their customers to interact with each other, right? So, for instance, we have customers that are remittance payments. So these remittance payment corridors, their respective customers don't know anything about crypto. They don't know anything about blockchain. They just want to send money to their family from country A to country B. The provider behind the scenes does the conversion through stablecoins. And that's a huge, huge benefit to them because the fees are much, much lower and the speed is much, much faster. So as a result, we're seeing stablecoins kind of like starting to really become a true use case, the one that the kind of killer use case that a lot of people looked for when they said like, digital assets needs to be beyond the speculation. Stablecoins is that. So obviously we are seeing a lot more usage of stablecoins, and it's there's a really, really good paper by Castle Island Ventures that provides a little bit more visibility backed by data into stablecoin usage and stablecoin adoption. And the trends are very, very positive there.
Okay, very interesting. Again, use case specific, different places, and that drives the fragmentation, but then also drives the adoption.
And because to your point, right? Different stablecoins for different things. Ultimately, today, I think like 99% of the stablecoins are denominated in dollars still.
Right.
It's not to say that there aren't other stablecoins, but it's just like the vast majority of the ones that are interacting on chain are USD. So you can already see different things, just different stablecoins being established there because you kind of need a Euro C, you need a couple of others, but also from what is the backing of the stablecoins? What is the risk associated with that stablecoin? On what chains are these stablecoins, right? Like what is the yield associated with the stablecoin? So all those kind of things are different from one stablecoin to another. There's also a different class of stablecoins, which is the algo stablecoins, which I think is, generally has not seen a lot of popularity, especially since the collapses that of the market. So we're primarily seeing the focus on actual, one-to-one backed stablecoins. So we'll see.
So that's also a trend that you see developing even more with the algo stable. No.
We're not seeing that too much. We definitely not on the institutional side. We haven't seen it on the retail side. What we've seen is a downward trend. Primarily the stablecoins that the major trends that we see are around stablecoins that have these kind of like one-to-one, but not necessarily one-to-one, but it's a perceived one-to-one backing. So backed by, US paper, treasuries, these kind of instruments that are a little bit more easier to audit, easier to understand. That's kind of like what we're seeing. The vast majority of the usage is there.
A little more old-fashioned, so to say.
Yeah, old-fashioned, but it's just a question of risk and audit and understanding. It's much easier to say like, hey, there's this token and it's backed 100% by these securities that we have been trusting the market with for quite some time. And as a result, a lot of institutional clients say like, okay, we'll understand the risk behind that, and we can take that on the balance sheet, or we can use it.
And maybe make those stablecoin issuers popular with certain issuers of paper, but we won't go into that topic just right now. Turning to the venue side again, we talked about the fragmentation of venues, and you see all of it right from your eagle view at the top at Talos. When people come and they have these choices of venues, what are the things that they are considering? What are the things that they look at Liquidity obviously being a big one, but what are some of the other granular details that they have to consider?
So obviously it really depends on the client, right?
Yeah.
The clients that are a little bit more risk friendly, I would say that there's a minority of those kind of customers, but they do trade quite a lot. They're looking for liquidity, and primarily they're looking for availability. So for instance, part of the reason why we added decentralized exchanges is because we have a class of client that wants to trade tokens or instruments before they are actually listed on centralized exchanges, right? The only place you can get that is in decentralized world. But for our institutional clients and the vast majority of the institutional clients, liquidity is the first thing. So you're absolutely right. But the very second is almost like the KYC equivalent of the exchanges. Understanding like what is the reputation of that particular destination, how do they work with the regulatory environment that our clients are in or the liquidity providers in, what is the level of technology that they provide, is it a known kind of technology, like do they know how to interact with it through the Talos rails, like is it providing the same kind of level of safety that others provide, and we comment on that quite often, right? They look at the level of support that they have, right? Institutions kind of need to make sure that no matter what happens, ultimately there is a person at the end of it. Now, Talos covers the very, a very, very wide breadth of that kind of service. We would connect, we would be the first one to call. We usually have a relationship with the liquidity providers. But ultimately, if there's something that needs to be escalated, the client needs to know that they have somebody to work with. So it's really, like it's now bubbling up to this level of merit that's starting to be considered on the liquidity provider side. And then some of the obvious other pieces is, like what is supported from a functionality and what is not. Are you able
Order
to
types and things like this?
Exactly. Order type, latency, co-located facilities, that kind of stuff. We support the wide gamut of all of those. And sometimes we are limited by the functionalities on the underlying exchanges. And obviously that's something that the client considers as well for their specific mode of execution.
And how deep does it go in that kind of KYC or KYV, know your venue, as in knowing who your counterparty is on the other side of the trade? Is that something that also comes into the list of details that people see when they come to a venue on Talos?
That's the very first thing. So it's that notion of understanding who's the other side. So there's generally, you obviously know this, but just to make sure we're on the same page, right? There's generally two big ways of executing, and that's you're either pre-funded or you're doing execution on a post-trade basis. Pre-funding has a lot of challenges with it. So very, very, I would say the institutions that are comfortable with pre-funding also comfortable with only a very small segment of venues that support pre-funding, because ultimately what do? You're taking this kind of like unbounded counterparty risk, right? You're sending your capital elsewhere. Then you're starting to think about the off-exchange, tri-party kind of agreement. That's kind of like a little bit in between. And a lot of that infrastructure is being built out today. And some of the liquidity providers now have that. And it's expected from the clients that some will have that going forward. And then there's the full post-trade, right? And the post-trade is like, hey, we agreed, you gave me credit, we traded, and then we're going to settle. You're still taking a risk there, but it's not a counterparty risk, it's now a market risk, right? Because you could walk away from your trade, and as a result, I'm mishedged or something like happened in the market and that is not accounted for in my trading activity, right? So generally, you can see how the institutional customers are definitely friendlier towards the non-pre-funded, the post-trade, or the intermediate, which is the tri-party. So that's kind of like what the clients look for.
Right. And of course, that latter camp is something that's very near and dear to our hearts at RuleMatch with the post-trade settlement. Things that, generally you would find in other markets.
That's part of the reason why we're excited about the relationship. Yeah. We definitely see the market moving that way. Now, it's not the entire market supports that right now, right?
Sure.
And the players that we have on our side, the larger institutional players, are still okay taking the risk sometimes on some of those venues, or they take the risk through a prime, right? But it is quite a risk that you would take on a venue that you're leaving your assets. It might be okay because the returns might be there, but it's always, the risk is a sizing function, right? You're thinking like, how much am I able to trade? We just think that in terms of like your activity overall as a customer, customers will just ramp up the activity a lot more aggressively and really trade to their full potential when they don't wear the counterparty risk.
Sure. We had a guest on the podcast just recently Episode's not published yet, but he was talking about how people forget about counterparty risk during bull markets. Things blow up, FTX, and then counterparty risk, and then all of a sudden, whoop, we forgot about that. But yeah,
I would say that has been changing quite aggressively. So before FTX, I would say 100% true. We would talk to clients, and even larger clients would say, like, listen, I mean, everybody's taking the risk. We're comfortable taking the risk. We know how to handle the risk. Those conversations are very, very few and far in between now after FTX. The compliance people a lot of times are in the room.
Yeah.
We have a huge portfolio management effort that's going on our side. There's a couple of things where they're going to be public very, very soon. We put a lot of effort into actually people understanding the risk, and the medium to largest institutions care about that immensely.
Yeah.
So it's not, like before FTX, you're absolutely right. After FTX, it's a conversation.
Whole different ball game. Yeah. Let's talk a little bit about market models, because that's also a place where it's a little bit different. You had central limit order books kind of also for retail. Now you have different kinds of platforms coming with more RFQ. There's different advantages and disadvantages. Just talk to us about how people think about that as well as the venue itself.
Absolutely. So, obviously we support every mode of execution that exists in the underlying destinations. Again, between the 70-something destinations we have, there's quite a lot of diversity, even in those specific domains of whether you're looking at central limit order book and RFQ, there's many, many flavors of that. Even in terms of support for order types, there's many flavors. So our job is generally to support all those and to provide our clients with the ability to execute there either synthetically, which basically means if the entity doesn't support it, we need to simulate it, or more natively, if the entity supports it, we roll it down. So the difference between the two, generally speaking, like the world kind of moved. It's phenomenal to see the pendulum swings a little bit, right? Initially, when you were connecting, especially OTC, RFQ was the only way to execute, and then Club, the essential limit order book, was primarily prevalent on the exchanges. Then what you're seeing is the OTCs started to move a lot more towards central limit order book like execution, where you can actually get either a full order book or you get a snapshot and you can actually execute, and you can send them and you will get price improvements, stuff like that. So you're no longer dealing with a particular RFQ. You can actually deal a little bit faster. But RFQ has a huge space right now in the entire industry. So if you're looking at how the larger sizes, how block sizes, how ETFs are traded, that's all RFQ. It's all RFQ, right? So it's actually settling. I mean, this from your previous life as well. It's settling into this institutional way of thinking about this, right? Central limit order book has very important hooks for large institutions to trade raw liquidity, to go and execute, to trade over time. And then you have block trading. And that's done primarily on RFQ, and we don't see that changing significantly. So it really depends.
And when you think about these different, again, venues, same question when it comes to liquidity. Do you see some consolidation, some coming together, some M&A? How do you see that developing in the next couple of years?
Unequivocally, yes. We've seen this. We've seen this a bunch, and we're very fortunate to be friendly with the liquidity because Talos is an independent entity. It's not we don't have a horse in the race. We do see a lot of the interactions that happen, a lot of the requests. So I do foresee quite a lot of M&A over the next 2 years, of next 3 years. It's also it's the market is slightly different now than it was in 22 as well. At this point, quite a lot of players got in at 22 and continue operating through this past 2 years, which is not easy 2 years. Market is definitely evolving right now. I think at this point, quite a lot of players are thinking about what is tomorrow looking like? Did we get to where we wanted to get? Do we see somebody that we can partner with that can get us there faster? So it's there's I think that there's a reasonable amount of M&A activity in store in the next 18 to 24 months.
Would technically, I guess, make your job easier since you would have fewer venues to support, or it would be kind of consolidated in one sense. Kind of. There's maybe not. For every M&A, there's another 10 that's coming into the market or 20. The job, honestly, the hardest part is when we started Talos 6 years ago, our focus was on connectivity and execution. It was primarily trading. Trading is still a major flagship product of ours. But today we have quite a few other things. Like today we support really we're a one-stop shop for a lot of institutions. They use us for portfolio management. They use us for risk. They use us for execution. They use us for post-trade, for
reporting, for TCA, for clearing, for settlement, for recon, right? So we support that entire investment lifecycle. One of the big challenges is actually how to partner best with folks, right? Because there's definitely a lot of demands coming in from the market about like, hey, let's connect. Talos has quite a lot of customers at this point globally, right? But we want to make sure we are, like we're connecting, and every time we connect to someone, it's not only that we pay for that connectivity, like we connect, we also need to make sure that we support it. We also, any kind of upgrades. So ultimately, you see that there's a lot of spend on connectivity alone on our side, and that's one of the challenges, to figure out how to prioritize it correctly, how to go after the right players there.
And just speaking about connectivity, has that become more standardized or easier over time for you to plug people into the platform, or for people generally to plug into these venues?
The answer is for sure yes. Just because it was a wild west 6 years ago when we started doing this kind of stuff, it's nowhere near capital markets still. It's easier for us for two reasons. One is because yes, there's more professional players are coming in. So some of the stuff that we see is a very familiar and known stuff to us, so we know how to interact with it. But honestly, the bigger reason why it's easier today is because we've developed a lot of infrastructure to be able to generalize some of these approaches and to be able to build it inside. Like we don't, when we build connectivity today, a lot of the code that's coming in is a code that is reused from more generic frameworks that we've created for connectivity. We invested a lot of efforts into this, into the testing, into the latency tools, into the core, and then we kind of like add on top of that. And still, the vast majority of the time when we develop to a venue is spent on safety. So our ability to recover state automatically, to go and understand like, hey, something is wrong. Let's reconnect. Let's inspect, and let's make sure that we are in the known state for our clients. So that automatic healing is a big component of what we write, and then testing.
Okay. You also mentioned latency, and of course another topic near and dear to our hearts. But more generally, how do you see latency developing among venues, and also as a consideration or a demand from clients that come to Talos?
Yeah. Again, like no surprises there. Latency is becoming much bigger consideration for customers than it ever was before. 4 years ago, it was a nonsensical conversation to talk about latency because everything was over the internet. A lot of the venues had their matching engines not necessarily built by people that have built matching engines before, but implemented in slightly different ways. A lot of it was facing retail, so different set of requirements than like for institutional clients than retail customers. Today, a lot of the players that we're seeing coming in, and are some of the major players, legacy players, are also kind of like revamped a lot of the matching engines and offer new connectivity types to make sure that, like latency, as you would expect it in capital markets, can abate. So we are seeing a lot of progress there. Clients are asking for it. Clients look at me. It's not like clients are coming in and they're saying, I want to only connect to latencies that connect to markets that support like under millisecond, sub-millisecond time latency. Customers care about execution. They look at it from a slippage perspective, right? It's our job to worry about latency, and that latency can be on your side, on the network side, or on our side.
Sure.
Right?
Yeah.
And sometimes like on the client side, but that's a whole different story. So it's the conversation is definitely a lot more prevalent now because latency does have pretty serious implications on execution and execution quality. Now, it still very much depends on the clients. We have plenty of clients that are coming in and they're saying like, we need to be like, we don't care about, the execution quality to the same level as some of the market making clients that we have. Because our alpha is, like in weeks, sometimes in hours, sometimes in days, sometimes in weeks, right? So they're like, we need to get into that position. The market is not going to be react. Let's make sure that we get into the position without, tipping the scales of the market, but we just need to get into that position. But more and more right now, people are looking at execution not as a source of alpha, but something where they kind of like they don't want to lose. That's part of the reason why we invest a lot in TCA. TCA, and we have real-time TCA and post-trade TCA. We provide the clients with the ability to actually see, here's your arrival, here's your slippage, and here's how we're progressing, and here's how much you're aggressive versus how much you're passive. This is what the algo is doing for you. So a lot more scrutiny around those kind of tools now than 4 years ago.
And again, that's something that very much comes from TradFi TCA. Is that something that you, I don't want to say build from the ground up, since there are maybe some standards in traditional markets, but it's not been there in crypto yet. So what were people looking for, and how did you tune that to what they want now versus what they maybe will want in the future, and what you can expect they will want in the future?
It's a great question. TCA has been an evolving product for us. So we had TCA pretty much right after we built the first execution algos. We built our first TCA platform, and again, like this is something that we've done quite a lot in our previous lives. So TCA was a natural progression. But in capital markets, as you know, quite a few players don't bother with TCA. They rely on the TCA of underlying players, some brokers, or maybe they rely on a third party like an ITG that they send. In equities world, very, very popular. We wanted to make sure that the traders have, from the very beginning, the tools to understand their execution, how they're doing, and also it's a tool for us to show why the platform shines. Yeah. It's not just the aggregation of liquidity, but it's actually how you address that liquidity, how you're executing with respect to liquidity. In reality, when we were building this, we started building TCA 5 years ago. At this point, five to 4.5 years ago.
Ages ago.
It was like maybe 5% of our clients cared about it at that point, at most. Like only the clients that came from capital markets and needed that specific execution cared about the TCA, and also just to check and say like, okay, we're not doing something stupid. Today, it's something that a lot more of our clients look at. We still provide our TCA to our customers. We also have on and off, we provide TCA to some of the liquidity providers as well, just to have them understanding of how to better serve our customers. Like if you are a liquidity provider, a lot of the stuff is in the dark for you, right? Yeah. You sent a price, but nobody executed on that price. You don't know if you're missing something, you're not missing something. We actually want to help the liquidity providers serve the clients better. Okay. So we provide some of that information to liquidity providers. So today TCA is a lot more, a lot more advanced and a lot more needed. And again, like there's the standard progression of TCA. You first build, you're like, okay, well, here's what I'm going to benchmark to, and you're building kind of like your initial TCA tools, and I'm going to look at Arrival, I'm going to look at VWAP, I'm going to look at a couple of things. Then we had a couple of more sophisticated clients coming in and saying like, what about markouts? We kind of need to understand impact, we need to understand this kind of stuff. Today we have a very large built-out suite of TCA tools, and we continue investing in that.
Okay. Just on the transparency topic, maybe it hasn't been such a topic right at the moment, but previously people talked about venues and about volumes and reporting around things on venues and some volumes being pumped and faked and so on. How has that evolved? I'm sure that's something that you try to provide as much transparency to your clients as possible. Is that better now, and is that something that just comes standard out of the box from venues that they have to be fully transparent, or is there still some digging that has to be done?
Some digging has to be done. We don't do a lot of we do analysis on the liquidity, and we do analysis on things like rejections and latency and a couple of other things. We don't look at things like wash trading, for instance, or things like that. There's quite a lot of other data providers that are actually looking at this information. We point the clients to the right resources to make the right decisions about like who the venue you should be going after. And obviously we can share from our experience because our clients talk to us and give us some of the feedback. But we don't, it's not something that we monitor religiously. It's almost like something that you kind of like know in the industry, and you have certain players that we trust that actually monitor that kind of stuff. But I think that there's a lot less of it now because I think that the light shines a lot brighter. And generally the kind of players that institutions go after have never been accused of, or maybe, like the accusations have been a while ago and we haven't seen those kind of instances. So we don't see like a crazy amount of wash trading on the exchanges that, the larger institutions trade on necessarily, but it's still there.
They've done their due diligence in advance and know which direction to head.
Yeah. And also look, I mean, any way you want to, again, like we're progressing into the institutional territory now, right? Yeah. We will see more and more monitoring tools, and there's a good number of vendors right now that are offering those kind of services to the exchanges. So if a vendor is working with that kind of exchange is monitoring its own activity for wash trading, for any kind of miscellaneous issues around trade surveillance, usually the institutional player will find it during due diligence. So the kind of again, like institutional players are not one type, right? Like you will have some that are very risk friendly and they will say like, listen, it doesn't matter. We're making money. Like we will do this. So there's a small number of clients that do this kind of stuff, but the larger clients generally will, during their due diligence, will figure out like, hey, yes, we can trust this liquidity will be executed. And we measure the execution quality. So even if, if you're not executing, it will be very, very easy to see why.
Yeah.
We would be able to detect the situation. We would know why that happened.
Yeah. Interesting. Let's turn now to the topic of settlement, which you also touched on, and that again is a bit of a fragmented landscape. There's different ways people do it, different windows for settlement. OTC desks have maybe special relationships with clients than other venues are more standardized. You have to accept whatever they want. Some of that gets overlaid with a PB. What are people looking for right now in settlement when it comes to institutions?
Yeah, it really depends on the clients. Again, as always, we do see a lot of clients. Look, I mean, being as predictable and being as close to capital markets norm is generally favorable. So one thing, like for instance, you mentioned OTC, right? Forever until like about a year ago, it was always actually the vast majority of the settlement with OTC was done this way. I trade with you, you gave me credit, you're an OTC, I'm a client, right? I traded with you, you gave me some credit, we traded on the credit. At the end of the day, maybe I traded in and out. At the end of the day, we see the net settlement, and I will be the first to act as a client. I will send you capital, you will send me capital back. Today, what we're seeing, like especially in the past year, is that because very, very large players are coming in and their risk departments are saying like, yeah, we're not going to do any of that.
Yeah. No way.
Exactly. We're seeing alternative modes. So either it is that there's a tri-party agreement and, the capital from both sides is traveling to this kind of like one point and released simultaneously. We are seeing for the first time OTCs as the first to ask, the first to act. Sometimes it's dependent on what the instrument of settlement is. So we're actually seeing a much larger variety of execution tools. And of course, as you mentioned, primes also play a pretty meaningful role. And so primes usually you would maintain as a client, maintain a margin with a prime. Prime is the one that settles back and forth with institutions. Of course, they pool that between multiple clients that they have, which provides quite a lot of capital efficiency. You don't have to park, tons of capital. You can kind of like intersect with a subset of the capital. And the same capital efficiency translates back to the customer as well. They can keep a margin instead of having the entire amount constantly allocated for that trading. So definitely we're seeing migration of settlement.
And you at Talos offer something which is called one-click settlement, if I'm not mistaken.
Yeah, I think we haven't trademarked that name technically. It's
Okay,
just one click.
It sounds nice from a marketing standpoint. How does that work actually?
Yeah, so what we do on our side is, again, because we have the connectivity to the underlying facilities, right? We have connectivity to the custodians, we have connectivity to the settlement rails, and we have connectivity to the exchanges and OTC desks. As our clients trade in the market, we have a special screen. Our clients, and again, like it might be some operational person on your side, or if it's a small shop, the trader might be doing both because we've seen that too. You are seeing your activity versus those counterparties. So how much money do you owe them? How much money do they owe you? We have a reconciliation reconciliation process that's running in the background and making sure that, what's being reported by the counterparties is actually true to our calculation. So we do that entire calculation as well. Once you see that you are reconned, maybe you want to settle at the end of the day, you can click a button on our screen and it will send all the instructions down to the settlement facilities. It's not going to bypass any of the policy tools that you have. So for instance, if you're using something like a Fireblocks or Copper settlement, right? It will go and it will ask Fireblocks or Copper or Coinbase to actually move those funds. It will still pop up on your screen as a secondary factor authentication, all that kind of stuff. But effectively, when you click the button on our side, that can facilitate your entire conversation, your entire settlement. So you don't have to anymore, log into one place, to another place, to another place, to another place to move your capital around. It will both calculate how much capital should be moved, and it will move the capital. And we support not only the custodians, but also the exchanges as custody providers, effectively. So that's the idea. The idea is always to save our clients as much time as possible and to make sure that, save time while, minimizing errors. That's basically the infrastructure that we develop.
And then that sits on top of the layer of then, like you say, all those policies and so on with the custodians. And
You're
so
exactly
on.
right.
Yeah.
Yep.
Okay. Interesting. Do you think that's going to be something that more and more people look for, or what is kind of the demand or reaction from that?
So far, it's been very popular. So we have, you know, we with the release of portfolio management tools that we have, that actually allows us to take a bigger portion of the conversation that's happening, generally the value chain that the client is going through, to see clients' assets, to be able to move those assets around, to understand the risk behind those kind of assets, and to facilitate clearing and settlement. Clients definitely, again, like this is a big change from 3 years ago, 4 years ago. Clients were very, very happy to do this themselves. They had maybe a spreadsheet and they kind of like, looked at this. But today the world is a lot more complex. You have more custody solutions. You have, true trading that you're doing. So you need reconciliation. You have more diversified portfolio. So you have more assets. Some of those assets might be yielding. Some of those assets have like other accounting considerations that you need to bring in. At this point, like you kind of need to be a lot more mature from portfolio management perspective. Clearing and settlement is a portion of that. So generally, we kind of like that falls under our treasury management function. And yeah, we're seeing more and more customers move towards that, especially the medium to larger side. And we've had a lot of these customers on board from the platform since the ETF was launched. It's kind of like, honestly opened up the floodgates a little bit. And those kind of customers, like it's a settlement is a part of everyday thing for them. They need the right tools. They need to be able to facilitate it, and they don't want to do it themselves. Like they have no capabilities or desire to build these kind of tools. So more and more relying on our tools to do that.
I'm interested to know how that sits then along. So in a traditional financial institution, that treasury management, that reconciliation, that settlement sits alongside then other assets and other traditional assets that they're managing as well. Is there a connection, speaking back and forth, that probably sits in their core banking system as well, right? Or how does that work?
Yeah. So again, very much depends on the clients. For the clients that are coming in from traditional worlds and adding crypto to some of their capabilities, you definitely see, connectivity between either systems or people or operations or all of the above, right? So we do have, we built Talos API first always. So even the UI that we have, the UIs that we have use exactly the same APIs that our clients would use to connect. So our clients can always choose whether they use an API or not, use UI or not. It's exactly the same for us, right? So as a result, part of the strategy why we built it that way is to be able to integrate with legacy tooling that they have. Because to your point, the larger institutions, this is going to be, or it already is, just another asset class.
Yeah.
It's not like, oh my God, it's something completely different, a different like financial environment. They're treating this as another asset class. If it treats it as another asset class, you need to think about it as unified risk. You need to think about it as like, and that goes true for things like reconciliation, not only, like portfolio risk. You have to think about settlement as well. So what we do see in those kind of institutions, that the same people in the middle and the back office that facilitate operations for other asset classes are also doing that here. And so we give them special logins, they have special permissions, they have special views, and it looks very familiar to them as it looked in capital markets. Now,
so you definitely
crypto
have
is
to
different,
have that.
right?
Let's move quickly to the PB topic.
Yep.
You mentioned them. They're coming in. This is very much part of the institutional stack that has to be there or should be there for things to really go bigger for institutions. Are the PBs at the level that they need to be to really facilitate these large players, or is there still some development going on?
It's a pretty complex question, right? Because what is the level that they need to be and who are they supporting? I think that the PBs are, first of all, there's not a lot of PBs. Like technically, if you really look at it, you can say that arguably there are 3, but really there's like 1. And so what we do see is that they are working as fast as they can to set up all the operations and get the correct balance sheet to support larger and larger customers. And a lot of times the PBs are bounded just by that, by the balance sheet that they have to work with those kind of customers. So generally, is it where it needs to be to support institutions that are coming in over the next 2 years? Probably not yet. I think a lot more needs to happen, but we know we work very, very closely with some of those players, and they're working very diligently on making sure that they have the right processes, they have the right certifications, they have the right balance sheets to be able to support that. So That's kind of like the biggest thing that's happening. And the hardest thing today in crypto to become PB, the hardest thing is to get access to the right balance sheet. So
Yeah.
you know,
So on the back of that, two topics, we had a guest recently who was talking also PBs and really saw some rivalry or some controversy between the PBs and exchanges, since somehow they maybe have some differing approaches, and maybe the exchanges, larger ones, don't want to let clients go away from trading directly. Or how do you see that?
it's I mean, I personally, I think that exchanges should welcome PB, because PB will actually allow clients to trade a lot more and more clients to get in, especially on the institutional side. Like PBs might not see, like the kind of liquidity that can come in behind the PB, exchanges might not see yet. So I think that the controversy you're referring to is a little bit more on the how exchanges make money versus how PBs make money, or a subset of their money. So there was this kind of like a lot of conversations, especially in the past 6 months, around, hey, can PBs offer fees of the highest tiers on those exchanges? And there you can see the exchanges are coming in and basically saying like, well, like you're taking it from our pocket. And you can kind of like, I'm not sure that I agree with this side or this side, because I actually think that, some of that money some of the capital or liquidity or volumes wouldn't make it to the exchanges otherwise. And so I think that the relationship is a lot more symbiotic. And we see quite a lot of exchanges that are very, very happy to work with PBs in any kind of capacities. But PBs offer a lot more than that.
Yeah.
The lending activity, the margin, cross margin, the capital efficiency tools that they have, the settlement, the reduction of risk, that's actually where you see the service coming in. That's where PBs really, really shine on being able to lend the right assets at the right time for the right customers, for the right level of risk, and eliminate that kind of risk both from the exchanges and eliminate the exchange risk from the customers. That intermediary approach, I think, is very important. And ultimately, I think that, you see this kind of like a little bit of tension, which you identified exactly right, between the exchanges and the PBs. I don't think I think it's just growing pains. I think that some of that stuff is going to go away, and it's going to get, they're going to get.
Yeah, it's not a zero-sum game in the end, actually.
That's exactly right.
On the other side, then, since you speak about the balance sheet, I mean, there are PBs who are coming in as PBs, right, with that hat on. Then there are, of course, banks who, depending on their size, have a certain balance sheet, who have never done non-PB work, maybe even in traditional markets, but could potentially make a business out of it in crypto. Do you see that as a trend?
Yeah. Absolutely, yes. There's been a good conversation with a number of very, very large players that are looking at how to do this. Now, they don't operate on the same time scale that we would be used to in capital in crypto. I'm sorry.
Yeah.
Right. It wouldn't be like, like in 2 months they're going to be releasing this and there's like $10 billion available. That just doesn't work that way. A lot of process there, but a lot of the people in the traditional world, in the banking world, are seeing this as a potential to provide capital inflection into digital assets, the crypto specifically. So I wouldn't be surprised if we see a couple of larger announcements in the next year or so. And I also do think that at some point, like what we are going to see, the typical thing, which is like, we're going to see probably one or two major, banks coming into this with quite a balance sheet. And we're going to see fast followers afterwards. And that's kind of like where M&A activity will pick up in this space as well. Because not everybody can get everything up and running that quickly. So I think that there's going to be some appetite to consolidate.
It takes a certain scale, and then it takes a certain wake-up call to other people who could do it, but somebody
I think you're exactly right
at the top didn't see the opportunity. Let's go to a topic which we have to talk about, maybe don't always want to talk about, but that's regulation.
Is it regulation?
You knew it was coming. Sorry. I mean, it's there, right? It's there. It's everywhere.
Yeah, of course.
And just going back to what we talked about before with venues, I mean, is regulation or changing regulation, in your opinion, going to change the venue landscape, or has it changed the venue landscape in your experience so far?
Yeah, and again, the disclaimer here is that regulation, it does tend to be pretty specific to specific regions, and so we've seen some regions that have had, where you are at the moment, regulation has been generally pretty clear. Like, of course, much more to develop there, but the Eurozone and Switzerland have been running forward with regulation and coming up with clear clearer guidelines in terms of what needs to happen. And as a result, we've seen quite a lot of institutional adoption in those kind of zones. I think APAC has done the same. And we've seen, as of late, a lot more of that in the United States as well. I've been very fortunate to be invited to the CFTC GMAC committee by the Commissioner Caroline Pham from the CFTC. And so, you are seeing quite a lot of regulatory efforts in the United States to provide clarity, to provide guidance. Generally speaking, there's a strong beta to the clarity of the regulator to the activity in the market.
Yep.
The ETF is the perfect example of that. Kind of caught quite a few of us by surprise that the approval came in, and the ETF approval was even more surprising than the Bitcoin approval. We barely had any kind of heads up to that.
Yeah.
But it shows that the regulator in the United States, which is ultimately, I know I said the regulation is very specific to jurisdictions, but they do talk to each other and they do look at each other. And like some of the markets look very, very similar. There's also interaction between the markets. And so regulation does move the market forward. The clarity does move market forward, and it does impact what kind of liquidity providers are coming in and how they're coming in, what kind of services they provide. Yeah. So I think there's going to be more guidelines in terms of how liquidity providers should be interacting with their customers and what's okay and what's not okay, and where you kind of need to be careful what the listing criteria is. My hope is that we're going to see more clarity there, and we're already seeing this outside of the United States, hopefully in the United States at some point too. The activity behind, again, like you and I talked about this a bunch of times, right? Like the separation of matching versus custody, right? I think a lot of people are thinking about how to do that correctly and how much of that is going to make it to regulation. So I do think regulation will shape how, what kind of players are coming in from a liquidity perspective. I mean, RuleMatch has a great advantage there, right? Like you've been on this kind of like, hey, we're going to be an institutional venue from the very beginning. We had this conversation when you guys were first launching the exchange. So, I think it's very important. I think it's going to continue becoming important until we have, finite kind of clarity level. There's never going to be finite clarity, but when we get closer. So, but yes, it's we're going to see this. We're also seeing the regulator take a very, very, the regulator is looking very closely at the liquidity venues, right? Yeah. They are, you've seen also enforcement actions by the SEC. They are looking at liquidity as kind of like the source of engagement in a particular sector. So I think that's not going to change. I think the regulator is going to be paying very, very close attention, both on the retail side and on the institutional side, who provides liquidity and to whom.
So we of course, sitting in Switzerland, but also right here in the shadow of Europe, and MiCAR is there. And my most recent guest on the podcast was actually from the European Commission. So he was talking through some of the things around MiCAR, and of course some things are still not clear. Just tell us what are your clients talking about, asking about, concerned about when it comes to liquidity and best execution and stablecoins and all of those things that are kind of the big question marks right now around MiCAR.
Yeah, look, generally there's a consensus across the clients that MiCAR is here to stay. There are questions about like where MiCAR stands with respect to MiFID, the more capital markets based regulation, and whether MiCAR is going to morph into something that's a little bit closer to MiFID. Is it going to be a part of MiFID? It's unclear. Yeah. The one thing is clear. You look at the so ESMA made ESMA had a couple of things that they released, especially around best tax, and that's actually like it's good. It's thoughtful progress to show to the market, where they're saying like, listen, you kind of need to consider best tax when executing. Now it's a guidance, right? Yeah. But generally guidance is perceived as something that you have to follow. So for us, it's great because they're effectively saying, a single venue cannot, you can't guarantee your client's best execution when interacting with a single venue. That's Talos comes in and says like, we can help. We can help. Obviously. And so the good thing is, we put a lot of emphasis at Talos on reporting from the very early days, because that's the kind of stuff we always had to do in capital markets. So, for instance, Talos does provide you with the ability to say, okay, when I interacted with this venue, I chose this venue, but here's what the entire market showed. So we have best text reporting on the Talos platform.
Justification, yeah.
Exactly. And we capture all that information. So at any point when you have a regulator coming to you and they're saying like, hey, I need to know why you did trade A, B, and C. Is it because Ian was a very nice guy and you liked it, or because Ian had the best price? We have, the ability to prove is the latter, despite the fact that Ian is also a nice guy. But, so it's very important. They're making it seem that they're making it clear, the regulator is making it clear that it's going to be important going forward. And the big thing that the clients should be considering is, are they compliant? What is reporting going to look like? Because ultimately, it's you will need to abide by the guidelines that are provided. So a lot of the work that we're doing right now is to understand with the clients, what are the capabilities, what are the requirements, how can we, work with our clients to make sure that they are compliant with the upcoming regulation. But everybody's going to be abiding by it.
Sure, and staying flexible because those things are still kind of being hammered out. That was also the message that came out of that conversation. That things
nothing new about that.
No, that's true.
It's also the case in capital markets. Some of the best years we had with one of the previous companies that I worked at, right, is some of the best years were when the regulator came out with the regulation that the market had to buy, and we basically had to rush and develop quite a lot of capabilities. But the return was that as a vendor, a lot of people relied on us to provide those kind of capabilities. So, and the market is always going to be moving forward. So you have to be, as a vendor, you have to be flexible to those tools. You're absolutely right.
Yeah. We're winding things up, but I don't want to skip a topic which is looking more forwards, and that is tokenization. I think at some point you at Talos expressed that you see yourselves as kind of a conduit into the tokenized world. That is a big world and also a bit fuzzy still. What do you mean by that, and how do you see that developing right now?
Yeah, I mean, so from the very beginning, our job is to bring institutions to digital assets. That's our role. That's our mission. That digital assets do not mean crypto. Crypto is a subset of digital assets. Our bet is that ultimately all assets are digital assets. We spent enough time, pretty much everybody here at Talos comes from capital markets, spent enough time building that infrastructure, knowing the kind of benefits you can reap when you're starting to move to digital assets, from a transparency, from a speed, from a capital efficiency perspective, movement of capital. The advantage is colossal. It's not going to be true for every little thing, but especially on the middle office to back office, we're seeing a lot of benefits. So ultimately, our belief is that we are going to see migration of existing legacy asset classes to digital assets rails. We forever built Talos to be able to be the conduit of that change, right? So we do support other assets today. We support FX for some of our portfolio engineering and portfolio management. We also support equity, so you can have a blended portfolio of assets on Talos platform. But ultimately, we're gearing up towards a wider adoption of tokenization of existing asset classes. That's exactly where we can shine, whether to provide, tools that connect legacy institutions and legacy vendors to digital assets, or to actually provide this more blended views of other assets and digital assets together. That's kind of like what our clients want. So we very, very bullish on tokenization. I don't think we're there yet. I think that there's a couple of really interesting green shoots, but it's going to take a little bit of time to get there. Having said that, we've been, our strategy is absolutely moving to other asset classes, in parallel with tokenization.
Being ready for that when it comes. Just interesting, I had a conversation also with Fireblocks, and they have, of course, a big network and a lot of things that they do facilitating tokenization. Talos, of course, has a different focus and business, but also a wide network. Are these the network effects from players like Talos, like Fireblocks, that will ultimately help tokenization to grow, like the plumbing that is being laid here, there, and everywhere? And will there be some rivalry, perhaps?
My hope is that it's actually quite the opposite. So we work very, very closely with Fireblocks. They're a good partner of our company. I think it's exactly the kind of services that they provide, the kind of services that we provide, that can allow institutions to enter tokenization almost seamlessly. Ultimately, my hope is just like we were talking about clients that use stablecoins, right? That don't even know that they're using stablecoins behind the scenes. I think that that's exactly what we're going to see in the financial markets when tokenization happens. Clients will still be able to do exactly what they do today. The use cases don't change. The banks provide a certain level of access to their underlying customers. Hedge funds take a speculative approach or other approaches in the market. But they will be able to do it faster. They will be able to, they will be able to obey much higher capital efficiency. There will have a lot more transparency into it. The risk is going to be lower, and that's going to be done through tokenization. But I think that players like us, players like Fireblocks are going to be, and others are going to be providing this underlying layer that provides those institutions with the ability to continue to execute. So my hope is that it's going to be done in concert. I don't think it's going to be, definitely don't feel like it's going to be winner takes all. I think it's going to take quite a few players to come together and provide their respective networks, their respective services to the clients.
Understood. We have one question that we always ask everybody. This is the crystal ball moment. If you look out into the future, maybe 3, 4, 6 months, either at Talos or in the market in general, is there something coming up that nobody is talking about yet that you can give us a hint on, or something that we should look out for?
I mean, by definition, we sit kind of like in the middle of everything, so we hear quite a lot of different things.
So what can you tell us? No.
I think I don't think it's anything that nobody's talking about. I think actually some of the things are very clear. The stuff that you talked about, I think stablecoins are people treat stablecoins as yet another FX instrument. I think that's wrong. I think you need to be thinking about stablecoins as its own, like FX is a part of it, but I think they can provide a lot more. Like ultimately, when I look at stablecoins, and I'm hoping that more and more people are going to be waking up to this, it's truly becoming a conversation of banking the unbanked. Yeah. Some of the premise of why digital assets are so attractive for the entire global population is because somebody without any bank accounts ever can get access to stablecoins, can get access to yield, can get access to investment strategies without any kind of previous experience or entering their local banking domain. So I think that stablecoins, we're going to see a lot more use cases there, a lot more interesting ones. What BlackRock is building with Biddle, this is another great example of something that can truly revolutionize how some of this stuff is done. And then, I really do think that we're going to see a lot more lending and borrowing that is going to ramp up over the next 12 to 18 months. I think that there's a lot more capital that's ready to get in, especially with interest rates going a little bit lower in the United States. I think we're going to see a lot more capital come in, and that's going to make super fuel the prime brokerage and the lending sector. I think we're going to see a lot more credit kind of stuff coming into the equation. But except from that, I don't have any any amazing
no secrets to tell. But obviously, with institutions coming in, that credit borrowing and lending space is obviously their domain. So yeah.
And it's crucial to the operations because again, like this is I think derivatives are again like one of those areas that people don't look at enough. As these institutions coming in, we're going to see a lot more derivative action that we're seeing today.
Understood.
So it's going to be. My bet is that 2025 is a very, very interesting market.
I look forward to it. Yeah. Super. Thanks a lot, Anton, for joining RULEMATCH Spot On. Look forward to perhaps another conversation down the road, and next time here in Zurich in the studio. I think that would be super cool. Thanks a lot.
Thank you so much for having me. Thank you very, very much.